asset classes, bearish conviction, and intermarket relationships are all saying, be careful. Almost every chart we follow related to risk assets looks weak. At some point, the charts will improve. That process may begin on Monday. It may begin in 3 days. It may begin in 3 weeks. It may begin in 3 months. But until we see improvement, we will maintain a bearish bias and an open mind. An intraday bounce, similar to the one that we saw on Friday, November 9th, is not necessarily improvement. We often ask ourselves, am I buying based on fear of missing out? Or am I buying based on real observable changes in risk appetite? When the charts improve, we're willing to become bullish and redeploy cash and cover our hedges. At some point, a bullish catalyst will surface, and hence the need to maintain maximum flexibility. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. Last week we reviewed a chart of bonds divided by stocks as of the close on November 2nd to draw the conclusion that there was not yet strong conviction from the bears. Let's review the same chart as of the close on November 9th. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll open the video with a chart that we reviewed last week of bonds, IEF, divided by stocks. When the ratio is rising, it's risk off. This is what risk on looks like. Last week we said we were near a resistance line for risk off. We also had Williams percent R had not yet reached a level that looked like the declines in the stock market between April and May. This would be bearish, we said last week, if we moved into this box. In a similar manner, we said if RSI moved into this box, that would be bearish, since it was similar to the peaking process in the S&P 500, which is here between April and May. MACD had not yet moved into this area here, which looks similar to the declines in April and May of 2012. Rate of change also had not moved into the orange box. Let's look at this chart as of the close on November 9th next. This is the same chart we just looked at. Now you can see it's as of November 9th up here in the left-hand corner. Last week we saw risk off bonds breaking out relative to stocks. This breakout here is similar to the breakout that occurred between April and May of 2012. This is the S&P 500 here to the left. You can see when the breakout occurred, stocks declined further. This is a bearish breakout for stocks and commodities and inflation assets. Scrolling down, last week we said Williams percent R had not yet filled the orange box. You can see between November 2nd and November 9th, this is a bearish fill here. RSI, in a similar manner, has moved into the bearish orange box. This is bearish for stocks, bullish for bonds, and bearish for commodities. MACD is also following the bearish script, moving into the orange box that we said had not been filled yet. You can also see this is a weekly MACD cross in place as of a weekly close. This is a bullish cross for bonds, IEF, relative to the stock market. You can see we had a similar cross here in April of 2012. Between April 1st and June 1st, the S&P 500 did not perform well. Rate of change also has moved into the orange box that we highlighted last week. Here you can see rate of change moving above the zero line on May 1st. Stocks accelerated to the downside. Here we did see a bounce, and I believe this is a bounce of roughly 58 points in the S&P 500, It is possible that we'll get a risk on bounce relative to risk off, but the odds favor lower lows in the coming weeks. To be successful in the market, you have to have lines drawn in the sand or reference points to make decisions. You can see 3 weeks ago, title of our video was Bears Gaining Traction. The following week, we reviewed a chart of the S&P 500 divided by TLT and drew several lines in the sand. Let's update those lines in the sand and see where we are as of the close on November 9th. If you want to review our analysis 3 weeks ago on this, find this video here on the Shavaco Capital YouTube channel. We have here is the S&P 500 risk on divided by TLT risk off. This is a weekly chart. 3 weeks ago, we made the argument that when this ratio is rising, that's risk on. This is what risk off looks like. You can see when the ratio is falling, this is the S&P 500 here where I have the cursor. This is risk off. The stock market falls. The point we made was resistance on the ratio tends to coincide with peaks in the stock market or periods of weakness in the stock market. Resistance, period of weakness. Resistance from this purple line, period of weakness. 3 weeks ago, we said this was major resistance, this mess and cluster here of support and resistance lines. This was major resistance for risk on. Seems pretty clear now that we failed at this resistance level. If you look at this slope here, it looks very similar to this breakdown here, again going back to April 1st to May 1st, 2012, where the stock market, where I have the cursor now, was weak. The lines we drew in the sand a few weeks ago were if RSI closed below 50, that looked like this peaking process here where the stock market was weak. Last week, as of November 9th, we closed below 50 at 44. That leans bearish for stocks and commodities. Williams percent R, the lines we drew in the sand where a weekly close below negative 50 would be bearish for stocks, and or a weekly close below negative 57 would be bearish. And again, that coincides with the peaking process that took place between April 1st and May 1st. Williams percent R closed well below those levels last week. Here, you can see it looks like this level here. Here looks similar to this point here where the stock market was weak going forward. If we come down to rate of change, we said 3 weeks ago that the odds of bearish outcomes would increase if rate of change closed below 3.75% on a weekly basis. Last week we closed below that, similar to this point here. This looks similar to last week's close here. Again, after this point here, the S&P 500 declined further. This is the S&P 500 weekly here where I have the cursor. 3 weeks ago, we said that the Copic curve had not yet rolled over, and we said keep an open mind. Well, 3 weeks later, it has rolled over. So there's really not much more to be open-minded about relative to this Copic curve here. We also said that a MACD bearish cross for risk on relative to risk off would provide a confirmation that the bears were now in control. Last week, bearish cross looks very, very similar to late April 2012, early May 2012. Bearish cross, bearish cross. If we move up from that bearish cross, which occurred roughly a little bit before May 1st, again going back to the S&P 500, the S&P 500 is here, is where I have the cursor. The bearish cross occurred here, and stocks fell for roughly 1 more month. Does any of this mean that stocks have to fall for the next few weeks? No, it doesn't. What it tells us is until we see improvement in these charts, we should continue to maintain a bearish bias. But we should have a bearish bias coupled with an open mind. We have potential support down in this area here, and if this ratio bounces and moves into this area here or here, we're open to becoming bullish. But until we see improvement, we'll keep a high cash position, a low exposure to longs, and we'll continue to maintain hedges to protect ourselves. These tables allow us to compare and contrast the levels that we just looked at on the prior chart. Here are the levels as of the close on November 2nd. You can see we closed above RSI 50. Williams percent R had not violated negative 57, and we did not have a MACD bearish cross on the chart of SPX, S&P 500 divided by TLT on a weekly basis. Compare where we were a week ago to where we are now. On November 9th, as we just showed, all of these levels have been violated, and why we've changed this from somewhat red to very red is all of these have now happened on a weekly closing basis, which was similar to May 4th of this year, May 11th of this year, and April 20th. The stock market went lower after all of these dates before bottoming between June 1st and June 4th before it moved higher. This is another risk on divided by risk off chart, S&P 500 weekly relative to the VIX. This is risk on, this is risk off. We've shown this chart on our blog, Short Takes, which you can find on our website. Here, point of the exercise, we said if support was broken here, this is a support break for risk on relative to risk off. Notice again, May 1st is coming up. May 1st was a bad time to own risk assets. We said if we got a weekly close below this line, it would raise a red flag. Last week, as of November 9th, red flag. We also have a bearish MACD cross on this chart. The bearish cross here came between April and May. This looks similar to this. From a bullish perspective, we do have some RSI potential support in play. Always have to keep an open mind. If this chart improves, we're happy to turn and become bullish, but we have to see clear evidence of a turn, which we do not have as of the close on November 9th. We'll see what Monday brings. One reason to keep an open mind is support and resistance levels between risk on and risk off are somewhat in a triangle now, which means the margin of error is getting smaller and smaller as this triangle comes together. We're looking now at a weekly chart of the VIX. The point of bringing this up is on this weekly chart of the VIX, this is RSI where you can draw trend lines. We do have some trend line resistance that has not been cleared here. And notice the last time we broke off of this resistance was in late May 2012. The market bottomed on June 1st. The point of showing this is if RSI on a weekly VIX moves into this white space, that confirms what we've seen from a bearish perspective. If RSI for the VIX bounces off and moves lower, that tells us to be open to a possible bottoming process and a buying opportunity. The VIX also has potential resistance here and here. So if the VIX moves up and blows through this, that's bearish for stocks and commodities. If the VIX comes up and bounces off and moves down, that tells us we may be getting close to a bottoming process. The fact that this resistance line and this support line are getting closer and closer tells us that this has to break one way or another soon. This would be a bearish break. This would be a bullish break for stocks and commodities if the VIX came down in this direction. Again, updating charts that we've looked at previously. If you continue to look at the same charts, it gives you a reference point. Here, this is the number of stocks, the S&P 500, the percent of them above their 200-day moving average. Last week, only 55% as of the close on November 9th. 55% of the stocks in the S&P 500 or above their 200-day moving average, which represents a de facto bull-bear demarcation line. This is your peaking process. This is the stock market. In the spring, you can see market breadth weakening, present day weakening. Point of the exercise, we're making a lower low on this. What we'd like to see at a bottoming process is this breadth indicator to do a few things. We at least want it to clear this blue moving average. Have not done that yet. We're still below it. And better yet, we'd feel better if it could clear both of these moving averages. And best yet would be to get the indicator, the black line, above both the red and the blue, and to get a bullish crossover where the blue moving average crosses above the red. When did that occur? That occurred in early July of this year. And if I move up to the S&P 500, after that, when breadth improved, the stock market moved higher. Also on November 9th, from a bearish perspective, notice here, right around May 1st of this year, RSI for this indicator dropped below 50. RSI is below 50 at 40. That's bearish. The indicator for breadth also experienced a bearish MACD cross between roughly April 15th and April 20th. We have a similar bearish MACD cross for the indicator here. Bearish cross. If I come up from the bearish cross, stocks did poorly. Like all of the charts we're looking at, this could improve beginning on Monday, and if it does, we're willing to change with it. This chart right now has not improved, and it tells us to remain patient. We'll close here with another chart we've reviewed in past videos. This is VEU. This is the Vanguard All World Stock Index, sans the United States, so this is a very good risk-on barometer. If VEU or global stocks are healthy, most risk-on assets will be healthy. This is very noisy, looks confusing. We're going to look at some very simple things here. We made a note on Wednesday, September 26th, that this support line here was holding. You can see as of the close on November 9th, we've broken this support line and this support line. There's some white space here all the way down to, let's call it 4175-ish, that could be filled. It's the indicators on this daily chart that seem to be more concerning. When MACD black crosses below zero, that tends to be bearish. Here, MACD black below zero. VEU was weak after that. Here, MACD black below zero. VEU was weak for a time after that. MACD black below zero. VEU was weak for a time after that. Can you see bounces? Sure you can. If we see bounces, we want to see real improvement in the charts. This is what's known as a sucker's rally. How can you avoid participating in a sucker's rally? You want to make sure that you see real improvement, not just fear of missing upside when markets go higher. Other things that are concerning here, MACD. If you know the way MACD works, when MACD has trouble, this MACD histogram, breaking above zero as it did from, let's say, mid-February until mid-April of this year. And we know that April and May was a poor time to be in stocks from May 1st to June 1st. This is a very vulnerable looking market here. It's exactly what it looks like today. This is very vulnerable until this improves in a meaningful way, as it did here after June 1st, and stocks bottomed between June 1st and June 4th. This is meaningful improvement. Meaningful improvement with a bullish MACD cross. We don't have any of that. Another concern would be stock market began a bottoming process between May 1st and let's call it July 1st. This is RSI trend line off of that bottom. This is a trend line for risk on that's holding. It's clearly broken now, which is bearish for risk, and RSI is now clearly settling below 50 and having trouble getting back above, let's call it 56 or 57. This is what a bearish period looks like. Upside momentum for VEU. If you know how to use Williams percent R, when Williams percent R has trouble maintaining or clearing negative 20, this white space here is a red flag for Williams percent R. We'd like to see Williams percent R momentum retake negative 20. Another thing on rate of change on this daily chart. Do we have any short-term bullish divergences on rate of change? No, we don't. In fact, rate of change is making a lower low here and is broken below these levels. We'd like to see a bullish divergence on the next low on rate of change to become more open to being buyers rather than sellers. The Copic curve here, this is what a bearish bias looks like between mid-February and mid-April. Copic curve here, kind of a flat, ugly look. Kind of a flat, ugly look. Stocks declined further after that. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.